All right, I want to start today with something that sounds almost ridiculous when you first hear it. Because honestly, that's exactly how it felt when I first read about it. A markdown file. Not a product launch, not a new AI model, not some breakthrough hardware. A markdown file. Roughly 200 lines of text. That's it. And yet within 48 hours, that markdown file was associated with about $285 billion being wiped off the market value of software and information services companies. That number is not a typo. $285 billion. And when people hear that, the immediate instinct is to look for some kind of dramatic villain or singular cause. They want a face to blame. They want a company. They want a moment. And the easiest story, the one that spread fastest, was this idea that Anthropic shipped something, markets panicked, and suddenly the software world collapsed. Clean, simple, headline-friendly, and also deeply misleading. Because what actually happened here is far more uncomfortable and, frankly, far more important for anyone who works in tech, finance, law, consulting, or really any form of knowledge work. So let's walk through what actually happened, slowly, carefully, and honestly. On January 30th, Anthropic released a set of plugins for Claude Cowork, which is their desktop AI environment designed to support real workplace tasks. One of those plugins focused on legal contract review. And if you've ever been anywhere near legal workflows, you already know how expensive and time-consuming that kind of work is. Reviewing NDAs, flagging non-standard clauses, comparing contracts against negotiation playbooks, generating compliance summaries. These are the kinds of tasks that, until very recently, required junior lawyers, paralegals, or expensive subscriptions to legal research platforms that bill by the seat, by the user, by the hour. Now here's the part that matters. Anthropic made that plugin open source. That means anyone could look at it. Anyone could read the prompts. And when people did, they realized something that should have been obvious in hindsight but wasn't priced in at all. The entire legal reasoning workflow in that plugin was driven by roughly 200 lines of structured markdown prompts. Not some massive proprietary system, not a secret algorithm. First-year law school logic wrapped in a clever workflow. A fancy prompt. That's it. Yes, there was a disclaimer. All outputs should be reviewed by licensed attorneys. Of course there was. But disclaimers don't stop markets from doing math, and the math was brutal. By Monday morning, Thomson Reuters had posted its largest single-day stock decline on record, down 16%. RELX, the parent company of LexisNexis, fell 14%. LegalZoom cratered by 20%. And it didn't stop there. The selling pressure spilled into private equity firms heavily exposed to professional services and knowledge work economics. Ares Management, KKR, TPG, all down roughly 10%. And at first glance, it looked like panic. It looked like overreaction. It looked like markets freaking out over a demo. And plenty of smart people said exactly that. This is ridiculous, they said. It's just a prompt. It's not even that good. Anyone could build this. And that's precisely the point. The markdown file didn't cause the crash. It revealed something the market had been trying very hard not to look at. For decades, the enterprise software economy has been built on one core assumption. Humans are the bottleneck. Every knowledge worker gets a login. Every login generates a license fee. Revenue scales linearly with headcount. That's how companies forecast. That's how Wall Street models growth. That's how valuations are justified. But what happens when humans stop being the bottleneck? If an AI agent can do the work of 10 paralegals without logging in, without seats, without user accounts, the value of the underlying data doesn't disappear. But the revenue tied to those 9 extra seats does, instantly. That's the part that hit markets like a freight train. And the signs were already there. Software valuations had been compressing for months. Forward price-to-earnings ratios had dropped sharply, marking the fastest 4-month valuation compression since the dot-com bust in 2002. Earnings season was already ugly. Software companies were missing revenue estimates at rates not seen since the post-COVID correction, even as broader tech continued to outperform. So no, this wasn't about Claude. It wasn't about Anthropic. It wasn't about a plugin. It was about the per-seat SaaS licensing model finally colliding with a reality it can't survive. Now, I want to pause here and be very clear, because this is where a lot of people get sloppy. The narrative that AI is killing software is wrong, flat out wrong. The world needs more software than ever. AI runs on software. Every AI agent requires databases, APIs, orchestration layers, middleware, storage, security infrastructure. Jensen Huang made this argument forcefully when he spoke at the Cisco AI Summit just days before the crash. He said the idea that software is being replaced by AI is illogical, because AI itself is software dependent. And he's right, completely right. But he's also defending the wrong thing. No one serious is arguing that software is going away. The argument is that the world no longer needs to pay for software the way it currently pays for software. That distinction is everything. And confusing the two is how incumbents lose transitions they absolutely should have survived. We've seen this movie before. Print media didn't die because people stopped wanting news. Newspapers died because the access model collapsed. The internet didn't make journalism worthless. It destroyed the idea that you had to buy an entire newspaper to read one section, and that advertisers had no alternative way to reach readers. The content survived. The business model didn't. Enterprise software is staring down the same kind of moment. The proprietary data is still enormously valuable. Thomson Reuters' case law databases didn't suddenly become worthless. Salesforce's customer relationship graphs didn't evaporate. SAP's resource planning logic still runs global supply chains. Adobe's creative ecosystem still underpins entire industries. Those moats are real. There's another moat that rarely gets talked about, and it matters just as much. Accountability. The wringable neck. Enterprises don't buy Salesforce because it's always the best CRM on paper. They buy it because when something breaks at 2 in the morning before a board meeting, there's a contract, a support line, and a legal framework that says someone is responsible. That accountability layer becomes more valuable, not less, as systems get more complex. So what actually died here? The pricing model. The assumption that you can charge every human who touches a tool a fat per-seat license fee, and that revenue will scale indefinitely with headcount. That assumption breaks the moment AI agents start doing work without logging in. And here's where things get really interesting. Because the stock market crash was loud, but the quieter story that followed matters much more. While everyone was watching stock charts, KPMG, one of the big four accounting firms, quietly pressured its auditor, Grant Thornton UK, to cut audit fees. The argument wasn't that audits were automated. The argument was that AI had changed the economics. Grant Thornton resisted at first, insisting that high-quality audits rely on expert human judgment. KPMG's response was simple: lower your prices or we'll find a new auditor. Grant Thornton blinked. Audit fees dropped 14%. That wasn't a market reaction, that was an operating reality. And once that precedent exists, it spreads. Legal fees, consulting fees, implementation fees, design fees. Every professional service that scales pricing with human hours is now exposed. Not because AI replaces everyone tomorrow, but because AI becomes leverage in every negotiation. That's the real fire spreading through the system. And this is where I'll insert my own view. I don't think this is a temporary adjustment. I don't think this snaps back. Once buyers understand that AI compresses labor costs, they will never willingly pay old rates again. That genie does not go back in the bottle. This is not a demo problem. This is a negotiation problem. And it's just getting started. Now, I want to stay on this idea of negotiation leverage for a moment, because I think it's one of the most misunderstood parts of this entire story. Most people hear AI disruption, and they immediately imagine replacement. They imagine robots taking jobs, software replacing humans outright, entire departments disappearing overnight. And that makes for dramatic headlines, but it's not how this actually plays out in real organizations, at least not at first. What actually happens first is something far more subtle and far more powerful. Prices get renegotiated. KPMG didn't say, "We're firing our auditor and replacing them with an AI agent." They said, "We both know the cost structure has changed." That's it. That single sentence contains an enormous shift in power, because once both sides acknowledge that the economics are different, every old pricing assumption becomes negotiable. And that logic does not stay confined to audits. Think about how many parts of the modern economy depend on the assumption that expert knowledge work must be expensive because it requires expensive humans. Legal research, financial analysis, consulting decks, compliance reviews, implementation projects. All of it has been priced around the idea that humans are the scarce resource. AI doesn't have to replace those humans to destroy that assumption. It just has to exist. And once buyers know that tasks can be done faster, cheaper, or with fewer people, they will use that knowledge aggressively, not maliciously, rationally. That's why I keep saying this wasn't really a story about a markdown file. The markdown file just made something visible that had been building pressure for a long time. It was like a stress fracture finally cracking the surface of a wall that had been under strain for years. Now let's talk about the market reaction itself, because this is where things get almost comical if you step back and look at it honestly. Bank of America's Vivek Arya called the sell-off internally inconsistent, and that's a polite way of saying the market was holding two completely contradictory beliefs at the same time. On one hand, investors were saying that AI infrastructure spending is unsustainable, that the CapEx boom will collapse, that companies are overbuilding compute and data centers for demand that won't materialize. That was one trade. On the other hand, investors were saying AI is so powerful that it renders existing software business models obsolete almost overnight, wiping out hundreds of billions in market value. That was the other trade. Both of those cannot be true at the same time. If AI is powerful enough to destroy the economics of enterprise software, then the infrastructure required to run that AI is underbuilt, not overbuilt. The so-called SaaS apocalypse is actually one of the strongest possible demand signals for continued AI infrastructure investment. Yet both narratives coexisted because Wall Street doesn't need to be logically consistent. It just needs to be tradable. The market rotates between contradictions. One week it prices in an AI winter. The next week it prices in an AI revolution so extreme that legacy companies can't survive it. And because no single firm has to hold both positions at once, the contradiction persists. That incoherence is the real story here. Not the markdown file, not even the crash itself. The fact that the market is struggling to understand how to price a world where software is more valuable than ever, but the way we charge for it no longer makes sense. And while that chaos plays out on stock charts, something much more concrete is happening inside companies. Enterprise software companies are facing not just a pricing model crisis, but a resource allocation crisis. And this part gets almost no attention, which is wild, because it might be the most existential issue of all. Think about what these companies actually spend their money on. It's not servers, it's not cloud infrastructure, it's not even sales, at least not primarily. It's engineering. Thousands and thousands of developers maintaining massive general-purpose platforms designed to work for millions of customers, each with slightly different workflows, requirements, and edge cases. That generality is expensive. Incredibly expensive. Every feature added for one customer creates complexity for everyone else. Every edge case needs to be maintained forever. Every backward compatibility promise becomes technical debt that compounds over time. And that was all acceptable, even profitable, in a world where buying software was cheaper than building it. But now, that assumption is under attack. Here's the uncomfortable truth. Every engineer maintaining a legacy SaaS user interface is an engineer not building agentic workflows. Every sprint spent polishing a one-size-fits-all dashboard is a sprint not spent rethinking the product for a world where AI agents, not humans, are the primary users. And that creates a brutal dilemma. These companies can't just abandon the old system. Their customers depend on it. Their revenue depends on it. But they also can't afford not to build the new system, and they have to do both at the same time with the same budget, while their stock price is collapsing and their investors are demanding answers. This is where transitions kill companies. And to make matters even harder, the economics of building software themselves are changing at a speed that most people have not fully internalized yet. We are rapidly approaching a world where the marginal cost of writing software approaches zero. Not in theory, in practice. Right now, we're already seeing systems that generate thousands of code commits per hour with minimal or no human involvement. We're seeing frameworks where code is explicitly not written or reviewed by humans. These aren't toys, they're production systems. They're running real workloads. And once you accept that reality, the buy versus build equation flips for the first time in decades. The entire enterprise SaaS value proposition was built on the idea that it's cheaper to buy a general-purpose tool than to build a custom one. That was true when software engineering was slow, expensive, and required large teams. If an AI agent can build a reasonably functional internal tool in an afternoon, that calculus changes dramatically for some organizations. Why pay per-seat fees for a tool designed to serve every company on Earth when you could have a tool designed to serve just your company? That's the promise of what people are calling vibe coding, or agentic engineering. And to be clear, I'm not saying this replaces Salesforce or SAP tomorrow. It doesn't. There are enormous barriers, especially around data integration, reliability, compliance, and accountability. Which brings us to what I think is the hardest problem in this entire stack, and it's not intelligence. It's not coding. It's articulation. Humans are terrible at clearly stating what they actually need. When a VP of sales says, "I need a better way to track the pipeline," that sentence contains maybe 1% of the information required to build a useful system. The rest is buried in tacit knowledge, unspoken conventions, organizational politics, exceptions that matter sometimes and don't matter other times, context that changes quarter to quarter. A good product manager spends weeks extracting that information through interviews, observation, and iteration. The question is whether AI agents can do the same thing. Not just write code, but understand the problem deeply enough to write the right code. I'm personally skeptical that we're fully there yet, especially for large enterprises. Context is fragmented, incentives are messy, humans contradict themselves constantly. That's not an easy environment for any system, human or machine. But progress is happening. Agents are getting better at asking clarifying questions. They're getting better at exploring context. They're getting better at observing usage patterns and refining their understanding over time. And that matters, because it means the window for incumbents is real, but shrinking. Their data edge buys them time. Their accountability edge buys them time, but only if they use that time to pivot in a fundamental way. Bolting a chatbot onto an existing UI is not a strategy. It's denial. And I want to zoom out here because this is where the story stops being about enterprise software companies and starts being about you, about me, about anyone doing knowledge work right now. The same dynamic applies at the individual level. If you're using AI to proofread emails you could have written anyway, you're bolting AI on top. If you're using it to summarize documents you would have read anyway, you're bolting AI on top. If you added an AI coding assistant but your workflow hasn't fundamentally changed in years, you're bolting AI on top. That feels productive. It feels like keeping up. But it's the same trap the SaaS companies are falling into. The real shift happens when you rethink how the work gets done from the ground up, and the pace of change right now is almost incomprehensible. Tools leapfrog each other within days. Context windows expand. Agent platforms emerge. What felt advanced 6 months ago already feels outdated. Even AI models struggle to keep up with their own evolution. This is what hyper-acceleration actually feels like. And I know that sounds like hype. I know people will roll their eyes and say it's exaggerated. But once you're living inside it, it stops feeling dramatic and starts feeling like another Tuesday. The gap between "I use AI tools" and "I have rethought how I work around AI" is widening rapidly. And that gap determines who benefits from this transition and who gets crushed by it. And this is where I think a lot of people, especially people who consider themselves fairly tech-savvy, underestimate just how different this moment is from previous waves of tooling change. Because this isn't just about learning a new piece of software or adding a new skill to your resume. This is about unlearning assumptions that used to be true and now quietly aren't. For decades, the default workflow for knowledge work looked roughly the same. Humans thought, humans decided, software supported those decisions. You had tools that made things faster or cleaner or easier to organize, but the human brain was always the central processing unit. Software existed to serve that model. What's happening now flips that relationship. AI systems don't just assist human workflows, they invite you to redesign the workflow entirely. And that's deeply uncomfortable because it forces you to confront questions that most organizations and most individuals avoid for as long as possible. Questions like, what parts of my job actually require me? What parts exist only because of legacy constraints? What assumptions am I making about how work must be done simply because that's how it's always been done? Enterprise software companies are facing that reckoning at scale, and many of them are failing it in slow motion. Take the typical SaaS response to AI so far. Add a chat interface. Add some AI-powered insights. Maybe generate summaries or suggestions. On the surface, that looks like innovation. Underneath, it's a refusal to let go of the UI-first model that everything was built around. But AI agents don't need dashboards. They don't need menus. They don't need a human-friendly interface at all. They need access. They need context. They need reliable data and clear accountability boundaries. Designing software for agents instead of humans is not a feature update. It's an architectural reset. And this is where the clock becomes terrifying for incumbents. Because rebuilding architecture, pricing, and go-to-market simultaneously is one of the hardest things a company can do even in stable times. Doing it while your stock price is under pressure, your customers are demanding discounts, and your competitors are experimenting with entirely new paradigms is brutal. And yet, not doing it is worse. The companies that survive this transition will not be the ones with the flashiest demos or the best marketing. They'll be the ones willing to cannibalize their own revenue before someone else does it for them. History is very clear on this point, even if executives hate hearing it. What makes this even more complex is that the falling cost of software creation doesn't just threaten incumbents, it also tempts customers. Once you realize that building custom tools is no longer unthinkably expensive, the idea of buying a massive general-purpose platform starts to feel less obvious. But here's where reality intrudes again. Building software is not the same as sustaining software. Anyone who has lived through a custom internal tool knows this. The first version is exciting. The second version is painful. The 10th version is where dreams go to die. Maintenance, edge cases, compliance, security, onboarding, institutional memory. All of that doesn't disappear just because the initial build was cheap. This is why I'm cautious about the more extreme takes that say enterprise SaaS is dead and everyone will just vibe code their own everything. That underestimates the value of durability and accountability. Enterprises don't just need software that works today. They need software that works at scale, under pressure, with legal and operational consequences if it fails. And that's where the incumbents still have real leverage, if they use it correctly. But leverage is not the same as immunity. The per-seat pricing model assumes a direct relationship between human effort and value delivered. AI breaks that relationship. Once value can be delivered without proportional increases in headcount, pricing has to shift toward outcomes, usage, value extraction, or some hybrid model that we haven't fully standardized yet. And that transition is going to be messy. There will be experiments. There will be failed pricing models. There will be angry customers and confused investors. But the direction is not optional. And again, this mirrors what's happening at the individual level in almost an eerie way. I talk to a lot of people who say, I use AI all the time. And when you dig into it, what they really mean is that they've layered AI on top of existing habits. They type prompts instead of Googling. They summarize instead of reading. They generate drafts instead of starting from scratch. All of that is useful, but none of it is transformative. Transformation happens when you stop asking, how can AI help me do this task? And start asking, why does this task exist in its current form at all? That's a much harder question. It's also a much more threatening one, because sometimes the honest answer is that the task exists to justify a role, not to create value. And that brings us back to the articulation problem, because this is where both individuals and organizations hit the same wall. Humans struggle to articulate what they actually want, especially in complex systems. We speak in abstractions. We use shorthand. We rely on shared context that isn't actually shared. AI systems, for all their power, still need input. They need clarity. They need constraints. The dream of fully autonomous agentic systems depends not just on intelligence, but on alignment with messy human reality. And that's where progress is real but uneven. In environments where context is well documented, structured, and accessible, agents already perform shockingly well. In environments where knowledge lives in people's heads, in Slack threads, in half-remembered meetings, progress is slower. That matters for enterprises deciding whether to buy or build. It matters for SaaS companies deciding how fast they can pivot. And it matters for individuals deciding how to future-proof their careers. My personal take is that we are in an awkward middle phase. AI is powerful enough to break pricing assumptions and workflows, but not yet powerful enough to fully replace the need for deep human understanding of organizational context. That gap creates chaos. It creates fear. It creates opportunity. The markdown file that triggered all of this didn't decide winners and losers. It compressed time. It took a transition everyone assumed would play out over 5 years and forced the market to price it in over 48 hours. And once time compresses, mistakes get punished faster. That's why I keep emphasizing urgency, not panic. There's a difference. Panic leads to bad decisions. Urgency leads to deliberate action. For companies, that means honestly evaluating whether their AI strategy is cosmetic or structural. For individuals, it means asking whether AI is making you slightly more efficient at the same work or enabling you to do fundamentally different work. Because here's the uncomfortable truth. The market doesn't care how hard you worked to get where you are. It doesn't care how long a business model has existed. It doesn't care how many people depend on a particular assumption. It cares about whether value can be delivered more cheaply, more quickly, or more reliably than before. That's what changed. And it's still changing. And this is where I want to slow things down just a little bit, Because when you're in the middle of a moment like this, everything feels loud and chaotic and overwhelming. Stock prices are swinging, new tools are dropping every week, everyone has a take, and most of those takes are either wildly overconfident or deeply dismissive. Neither of those positions is very useful if you're actually trying to navigate what comes next. So let's ground this. The per-seat SaaS pricing model is broken. That much is clear. It worked when humans were the unit of work. It worked when access to software implied access to value. It worked when productivity scaled roughly linearly with headcount. That world is gone. But what's underneath that model is not broken. The data is still valuable. In many cases, it's more valuable than ever. AI agents don't eliminate the need for structured, proprietary, well-maintained data. They amplify it. They depend on it. Without reliable data, agents hallucinate. They fail silently. They make mistakes at scale. Enterprises cannot afford that. And the accountability layer is still critical. Contracts, SLAs, legal liability, escalation paths, professional services teams, those things don't disappear just because software gets smarter. If anything, as systems become more autonomous, the need to know who is responsible when something goes wrong becomes even more important. So this isn't a story about collapse. It's a story about repricing, re-architecting, rebuilding. The companies that survive this transition will be the ones that understand that distinction. They won't cling to per-seat licenses just because that's what Wall Street is used to modeling. They'll find ways to charge for value delivered, for data access, for reliability, for accountability, for outcomes, even if that means short-term pain. And to be clear, this is incredibly hard to do. There's no playbook. There's no clean precedent. Every path forward involves risk. But pretending nothing has changed is not a strategy. It's a delay tactic. And this is where I want to bring it back to something personal, because it's easy to talk about trillion-dollar companies and abstract market forces and forget that this transition is hitting individuals just as hard. The same assumptions that are breaking in enterprise software are breaking in careers. If your value is tied to doing something that can now be done faster, cheaper, or more consistently by an AI agent, you are exposed. Not doomed, exposed. And exposure doesn't mean you panic. It means you adapt. What doesn't break is your domain expertise, your judgment, your ability to understand context, nuance, trade-offs, and human dynamics. Those things still matter. They may matter more than ever. But the way you express that value has to change. Using AI as a bolt-on is not enough anymore. That's the equivalent of a SaaS company adding a chatbot and hoping the market doesn't notice the underlying structural problem. It feels productive. It feels safe. It is not sufficient. The people who will thrive in this environment are the ones who rethink their workflows from the ground up. Not just how they do tasks, but why those tasks exist. What inputs matter. What outputs actually create value. Where human judgment is essential and where it isn't. And yes, that's uncomfortable. It forces you to question parts of your job that may have defined your identity for years. But ignoring that discomfort doesn't make it go away. It just delays the reckoning. One of the most striking things about this entire episode is how fast it happened. A transition everyone expected to take half a decade got partially priced in over a single weekend. That doesn't mean the transition is over. It means the clock is now visible. And that clock isn't stopping. I don't say that to scare you. I say it because I think understanding reality clearly is empowering. This is a moment where deliberate, thoughtful adaptation actually matters, where small decisions compound quickly, where rethinking how you work today can put you years ahead of someone who waits. A 200-line markdown file didn't decide who wins and loses, but it did rip the bandage off. It forced everyone to confront assumptions they were comfortable ignoring. And once those assumptions are exposed, they don't magically become true again. The software didn't die. The data didn't die. Accountability didn't die. What died was the idea that you can keep charging for access to tools in a world where access no longer maps cleanly to value. And that same lesson applies everywhere. So my advice, if I can offer one thing to take away from all of this, is simple, but not easy. Don't bolt AI onto your life and hope for the best. Don't wait for clarity that may never come. Start rethinking now. Experiment. Break workflows. Rebuild them. Learn what these tools can actually do, not in theory, but in practice. Because the people and the companies that come out the other side of this transition stronger will not be the ones who predicted the future perfectly. They'll be the ones who adapted faster than everyone else. And that's the real story behind the $285 billion crash. If you enjoyed the video, like, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important analysis update. Thanks for watching, and I'll see you in the next one.